Alright, so SPY just bounced back from its worst day since April, sitting less than 2% from all-time highs. But here's what nobody's talking about. We've got four massive forces pulling this market in completely different directions, and two critical deadlines in the next 3 weeks that could determine whether we're heading to 700 or back down to 630. Look, if you're short on time or just stumbled onto this channel, here's what matters right now. With SPY sitting at the current level, we're in what I call show me mode. I personally think the market won't commit to a direction until we get September's CPI data on October 24th and see what happens with the China tariff deadlines on November 1st and 10th. Most likely scenario, choppy, volatile trading between 650 and 670 until we get those answers. That's the headline. But if you want to understand why this setup is so unusual and what the smart money is actually watching, well, stick around. Hey there, for those of you who are new, DataCat here. Welcome. This channel's about 3 months old now, which honestly still feels surreal to me. I spent years as an analyst inside a Fortune 50 company, crunching numbers in windowless conference rooms, and now I'm here talking to you from my home setup with my mechanical keyboard and my cat who is ignoring me as it's not dinner yet. I'm obviously not some trading guru with a Lambo. I'm just someone who learned to read market data the hard way and figured I'd share what I see. If you find this helpful, I'd really appreciate it if you hit that subscribe button. It actually helps more than you'd think, and honestly, as an introvert, seeing that number go up is about the only validation I get these days, aside from my cat judging me slightly less when I remember to feed him on time. Anyway, let's talk about what's happening with the overall market right now, because this setup is genuinely fascinating from a risk management perspective. So where are we technically? SPY closed Tuesday at $662.23. Now here's the thing. We're 94% through the 52-week range. That means if you look at where SPY has traded over the past year, from its lowest low to its highest high, we're sitting way up near the top. Specifically, we're only 1.7% below the all-time high of $673.95. On the surface, that sounds bullish, right? Like, oh, market's strong, everything's fine. But, and this is important, the how matters just as much as the where. Let me explain. The RSI cooled down to 51, but a few weeks ago it was above 70, which is considered overbought. So we've had this digestion phase where the market's been catching its breath. That's actually healthy though. You don't want a market that just goes straight up without pausing because those tend to crash harder. But here's where it gets tricky. On October 14th, the market opened lower, slowly crawling back higher to Monday level, then decided to give back those gains near market close. The intraday volatility was almost 2%, which is, well, it's high. And volume was elevated at 88.6 million shares, about 10% above the 20-day average. What does that tell us? It tells us there's disagreement, big disagreement. Some people are buying, some are selling, and nobody's really in control right now. Now if we zoom into the shorter time frames, the 5-minute RSI hit 72.5 on Tuesday, which is overbought territory. But on the daily chart, the stochastic oscillator, which is another momentum tool, shows K is below D and both are under 50. That's typically oversold, suggesting a potential bounce. So you've got short-term overbought, longer-term oversold. It's like the market can't decide if it wants to be a bull or a bear, so it's just being my cat. Sitting in the middle of the room, staring at nothing, pretending it's not listening, refusing to commit. Very on brand for me, honestly. Alright, so why is the market acting like this? Well, there are four major forces at play right now, and they're all pulling in different directions. Force number one, China trade war escalation. This is the big scary one. A quick recap here. Last Friday, Trump threatened 100% tariffs on China after Beijing imposed rare earth export controls. SPY dropped 2.7% that day, worst single day since April. That's not a small move. On Monday, we got a relief bounce because of the infamous taco trade. Then on Tuesday, Trump threatened to ban Chinese cooking oil imports because China's been boycotting US soybeans. Now I know that sounds almost comical, like we're arguing over condiments, but this is serious. These are retaliatory moves in an escalating trade war. So here's the critical part. The current 30% US tariff on China versus China's 10% on US goods expires November 10th. That's less than a month away. And Trump's threatened to implement additional tariffs as early as November 1st. So we've got two deadlines coming up fast, and right now, negotiations seem to be going poorly. You can say that the rhetoric's getting worse, not better, and markets hate uncertainty. They can price in bad news, but they can't price in we don't know what's going to happen. Force number 2, Powell's dovish pivot. On the flip side, Fed Chair Jerome Powell recently said something that got everyone's attention. He signaled that the QT program, that's quantitative tightening, where the Fed's been shrinking its balance sheet, might end in coming months. Now that's a dovish shift. It means the Fed's potentially done tightening financial conditions, and markets love that. It's like your strict parent suddenly saying, you know what, maybe you can stay out past curfew. This helped SPY rebound in noon after the opening massacre. But here's the problem. Powell's dovishness only makes sense if inflation is actually cooling. Which brings us to force number 3, the missing CPI report. So September's CPI report was supposed to come out October 15th, but because of the government shutdown, it got delayed to October 24th. That's next Friday. Why does this matter? Because August CPI came in at 2.9% year over year, up from 2.7% in July. Core CPI was 3.1%. That's not great. Inflation's supposed to be going down, not up. If September CPI shows continued acceleration, anything above 3%, it completely undermines Powell's dovish stance. Another recap here. The Fed can't ease policy if inflation's re-accelerating. They'd have to stay restrictive longer, which means higher rates for longer, which is bad for stocks. But if CPI comes in cooler, below 2.8%, then Powell looks smart, rate cut expectations get validated, and we probably rally. So the market's basically in limbo until October 24th. We're waiting for the data to tell us who's right. Force number 4, bank earnings and economic health. Third quarter earnings season just kicked off and the big banks reported this week. JP Morgan beat estimates on Tuesday. Trading revenue hit a record $8.9 billion, fixed income up 21%, equities up 33%. All sound great, right? But here's what CEO Jamie Dimon said. He warned of heightened uncertainty from geopolitical conditions, tariffs, elevated asset prices, and sticky inflation. And JP Morgan increased their credit loss provisions by 9% to $3.4 billion. Let me translate that. Credit loss provisions are money banks set aside for loans they expect to go bad. When they increase those provisions, it means they're expecting more defaults, more people or businesses not paying back their loans. That's a yellow flag for economic health. Goldman Sachs also reported Tuesday, profits surged 37%, investment banking fees up 42%, but the stock fell in pre-market trading. Classic sell the news dynamic. The results were good, but they were already priced in. So what are we seeing? Basically, strong third quarter results driven by volatility and M&A activity, but cautious forward guidance. Banks are preparing for a rougher road ahead. You know, I want to pause here and share something personal because I think there's an important lesson in what's been happening this week. I'm not a trading guru. I don't have some perfect track record. I make mistakes. And I lost money on Tuesday because I got hot-headed. On Tuesday, after that Monday bounce, I saw SPY pushing higher from its low at open and knowing, okay, this is just the morning reversal. I didn't wait for a clear trend confirmation. I didn't check if we were breaking through resistance with volume. I just got in too early and I gave back last week's profit. It's frustrating, right? Because intellectually I know better. I know you're supposed to wait for confirmation. I know you don't chase moves in a choppy market. But in the moment, when you see price moving and you're afraid of missing out, emotions take over. And that's the thing about markets like this. When you've got four major forces pulling in different directions, when you've got critical data delayed, when you've got geopolitical deadlines looming, the market's going to whipsaw. It's going to fake you out. And if you're not disciplined, if you're not patient, it's going to take your money. So, lesson learned. Again, for like the 100th time, maybe one day it'll stick. My cat certainly seems to think I should know better by now, based on the judgmental stares I've been getting. Alright, so what should we be watching in the days ahead? Today, October 15th, Bank of America reports earnings. Expected earnings per share of 95 cents, up 17% year over year. This is important because Bank of America has huge consumer exposure. Credit cards, mortgages, auto loans. If they're seeing stress in consumer credit, that's a red flag. October 16th through 18th, we get more bank earnings. Morgan Stanley, others. We'll be watching for the same things: trading revenue, investment banking fees, and most importantly, credit provisions and forward guidance. October 24th, the big boss, September CPI. This is the data point that could break us out of this range. If it comes in hot above 3%, we're probably heading down towards 650 or lower. If it comes in cool, below 2.8%, we could rally back toward the highs. November 1st, Trump's threatened deadline for the 100% China tariff. Will he actually do it? Is this negotiating theater? We don't know, but the market will start pricing in the risk as we get closer. November 10th, the current US-China tariff truce expires. This is the real deadline. If there's no deal by then, we're in full-blown trade war territory. So, given all of this, what are the likely scenarios? Well, the base case, choppy consolidation between 650 and 670. This is the higher probability outcome for now. The market digests these conflicting signals, strong earnings versus geopolitical risks, and just trades sideways with high volatility. What would cause this? CPI comes in somewhere in the middle, 2.8 to 3%. Not great, not terrible. China trade rhetoric continues, but no immediate action before November 1st. Bank earnings stay solid, but guidance remains cautious. Technically, SPY would oscillate between the 50-day moving average at $651 as support and the recent highs around $673-74 as resistance. Strategy in this scenario: range-bound trading. Sell rallies near 670, buy dips near 655. Don't chase. Wait for the edges of the range. Then the bull case, break out to 680 to 690 from what we are seeing here right now. This is the lower probability outcome, but it's possible. What would cause this? September CPI surprises to the downside below 2.7%, validating Powell's dovish stance. US and China reach a preliminary deal before November 1st. Trump's art of the deal playbook: threaten hard then make a deal. Third quarter earnings momentum accelerates with strong forward guidance. Powell reiterates the QT timeline in upcoming speeches. Technically, we'd need to break above $673 with strong volume. That would trigger FOMO buying, and we'd target the Fibonacci extension around $680, then the psychological level of $700. But then again, this requires multiple things to go right. It's possible, but it's not the base case. And here's how I'm thinking about this. SPY is at a critical juncture where tactical strength meets strategic uncertainty. We're 94% through the 52-week range. We've got a golden cross, which is typically bullish, but we're facing 4 major tests in the next 2 to 3 weeks. Can earnings justify these valuations? That's ongoing, and so far the answer is maybe, but guidance is cautious. Will inflation cooperate with Fed dovishness? We'll know October 24th. Can the US and China avoid a full-blown trade war? We'll know by November 1st and 10th. Is consumer and credit health deteriorating? The rising credit provisions from banks suggest yes, at least on the margins. The most likely path, in my view, is continued volatility with a slight downward bias towards 650 to 655 as markets de-risk ahead of CPI and the tariff deadlines. Then, if the data or negotiations surprise positively, we could get a relief rally, but right now, the risk-reward favors caution. Wait for clearer signals from the October 24th CPI before making big directional bets. The market is essentially in show-me mode. That's show me inflation is cooling, show me a China deal is possible, show me earnings can sustain these valuations. Until we get those answers, expect whipsaw action. Look, I know this is a lot of information, Markets are complicated right now because there are so many moving pieces. But that's exactly why it's important to stay disciplined, to wait for confirmation, and to not let emotions drive your decisions. Trust me, I'm speaking from very recent, very painful experience on that last one. If you found this breakdown helpful, please hit that like button and subscribe. It genuinely helps the channel grow. And as someone who's still figuring out this whole YouTube thing, I really appreciate the support. Drop a comment if you have thoughts on where SPY's headed, or if you think I'm completely wrong. I read all of them, even the ones telling me my cat would make better trades. She probably would, honestly. I'll be back with more analysis as we get closer to that CPI report and those tariff deadlines. Until then, stay patient, stay disciplined, and remember, in choppy markets, the best trade is often no trade at all. This is DataCat reminding you that sometimes the smartest thing a cat can do is just sit and watch. I'll see you in the next one. Meanwhile, perhaps I will just hop on to Battlefield 6 again. Stay safe and stay sharp out there.